section of our Smart Money Concepts course. I'm excited to begin this journey with you as we explore how to trade like institutions rather than against them. In this section, we'll discover what smart money concepts are, who the key institutional players are, and why understanding their actions is crucial for your trading success. By the end of this video, you'll have a solid foundation in smart money concepts that we'll build upon throughout the course. Smart Money Concepts, or SMC, is a trading approach that focuses on identifying and aligning with institutional trading patterns rather than fighting against them. In traditional technical analysis, we often look at indicators, patterns, and oscillators to make trading decisions. But SMC takes a different approach. It focuses on understanding the intentions and actions of the largest players in the market, the institutions. This concept is important because these institutional players control the vast majority of capital in financial markets. When they move, markets move. By learning to identify their footprints on price charts, we can position ourselves to trade in the same direction rather than becoming their liquidity. SMC was developed by Michael J. Huddleston, better known in trading circles as the inner circle trader. While Huddleston popularized these concepts, they build upon market theories that have existed for decades, particularly the work of Richard Wyckoff from the early 20th century. Wyckoff observed that large financial institutions, which he called the composite operator, followed specific patterns when accumulating or distributing positions. What Wyckoff called the composite operator, modern SMC refers to as smart money. Let's look at a real example. During the 2008 financial crisis, while many retail investors were buying into falling markets, catching the proverbial falling knife, institutional players had already begun distributing their positions months earlier. Those who understood how to read institutional footprints could have identified this distribution phase and protected their capital. So, who exactly is smart money? In SMC terminology, smart money refers to institutional market participants who control substantial capital and can influence market movements. These include central banks like the Federal Reserve, European Central Bank, and Bank of Japan, commercial banks like JP Morgan, Goldman Sachs, and Citibank, hedge funds managing billions of dollars, proprietary trading firms that trade their own capital, and market makers that provide liquidity to markets. Now let's discuss how you can begin applying this knowledge in your own trading. The process involves understanding the core philosophy, learning to identify key SMC elements, aligning your trading with institutional direction, and practicing on historical charts before trading live. A fundamental principle of SMC is that markets are not random, but are manipulated by design. This doesn't imply illegal manipulation, but rather strategic price movements orchestrated by institutions to facilitate their trading objectives. For example, when you see price repeatedly testing a support level, like in this pound US dollar chart, don't automatically assume it will hold. Consider that institutions might be trying to create a concentration of stop losses below that level, which they can target for liquidity. This leads us to an important concept: the liquidity game. For institutions to execute large orders, they need sufficient opposing liquidity, other market participants willing to take the other side of their trades. If institutions want to buy, they need sellers willing to sell at favorable prices. If institutions want to sell, they need buyers willing to buy at favorable prices. Many traders make the mistake of relying solely on traditional technical indicators like RSI, MACD, or moving averages. While these tools have their place, they often put retail traders at a disadvantage by focusing on lagging indicators rather than institutional intentions. Instead, you should focus on understanding market structure and identifying areas where institutions are likely placing their orders. This ensures that you're trading with the smart money rather than against it. Another common mistake is trying to catch falling knives or fighting against the prevailing trend. According to various broker reports, approximately 70 to 80% of retail forex traders lose money, often because they're unknowingly trading against institutional direction. Let's analyze this complete example from the US dollar Japanese yen market. First, we identify the overall market structure on the daily time frame. We can see a series of higher highs and higher lows, indicating an uptrend. Zooming into the 4-hour time frame, we can identify this area as an order block, the last price action before a strong move in the opposite direction. This likely represents an area where institutions placed significant buy orders. When price later returned to this order block, it provided a buying opportunity. Our entry would be near the top of the order block, because this is where institutional orders are likely concentrated. We'd place our stop loss below the order block to protect against the possibility that the institutional orders have been filled and the price continues lower. As we can see, the trade developed as expected, with price respecting the order block and continuing in the direction of the overall trend. This happened because we aligned our trading with institutional intentions, rather than fighting against them. To summarize what we've learned, Smart Money Concepts focuses on understanding and aligning with institutional market participants. Markets move based on liquidity needs of large players. Traditional technical analysis often puts retail traders at a disadvantage. Successful SMC trading requires understanding market structure and institutional positioning. Before moving to the next section, I recommend you practice identifying market structure on at least 5 different charts. Research the major institutional players in your preferred markets. Set up a clean chart template in TradingView without excessive indicators, and begin a trading journal that includes sections for SMC analysis. In our next section, we'll explore the liquidity game in more detail, understanding how institutions create and exploit liquidity. This knowledge will be crucial for identifying high-probability trading opportunities. See you there.